I put out a video about Title II of the Dodd-Frank Act and the powers that the FDIC has to basically confiscate your deposits over 250,000 and turn it into stock in what they create over one weekend. It's a brand new bank, from a failed bank on Friday night to a brand new bank on Monday morning, and they just take your funds and then they give you stock in a company. And this friend of mine said, "Is that serious? I didn't know this was a thing." And I wrote back and I said, "You saw exactly what the FDIC was saying in their meeting, that they felt it was necessary to keep a lot of the banking laws not secret, because they have to have transparency according to the Congress, but not to announce it, to just put it out on some website someplace, because otherwise we might scare the public." And then they would explain their new powers to those that had a need to know. It's been a week since I filmed this, and I sent the transcript over to an attorney that has a policy with me, and this is what he had to say. "Eric, this is awesome." In other words, he didn't understand this banking stuff, which reminded me about, I don't know, 2, 3, 4 years ago, I was showing a client who's also an attorney and has a master's in finance from Harvard about this stuff, and he admitted he was never taught this in college. Even with a master's of finance from Harvard, he didn't understand this, and as an attorney. So listen what he has to say. The reason I'm pointing this out is that if 2 attorney friends of mine didn't understand this, why should you?
Yeah, math's amazing, right? When it starts to work in your favor.
Well, and that's the whole point, is when you're paying a bank interest, when does it work in your favor?
Yeah, it's not. Yeah,
And when when you're your own bank, when is it in your favor?
it's kind of amazing though when you think about it. Like, try to, I guess, use my own words to explain this thing.
I'd love to hear you choose it. You're the one that's the financial guru, not me. I'm just a dumbbody. I got an MBA. I don't have a degree in finance.
I don't think so. I think you're pretty intelligent when it comes to this stuff. Um,
But isn't that amazing? You've got a degree in finance, right?
yeah,
And you were never taught this.
never. I mean,
Anyhow, the response of my friend that he had no idea this was a thing, I thought, well, why didn't he? But you see, and I just grabbed these off of a shelf. I have here books that I've been reading for the last 10 years, all about banking and insurance and what's safe and what isn't. I thought, why don't I just go out and ask 10 or 15 questions that I think would be the most important for someone to understand about the banking system. And I'll just go to 3 different AI models, and it'll give you an idea as to what the banking system is really about. And so this will give you the opportunity to see the question, then you can go back to your favorite AI model, ask the same question, but this time tell it to go more in depth so that you can learn even more. Hope you enjoy this. The first question that I asked the AI models was, when I deposit money in a bank, do I retain legal ownership of that money, or does the bank own it? This is something a lot of people do not understand because they think a bank is their custodian and it's their money. Legal ownership. The bank owns your deposits. They become the bank's property when deposited. Let that sink in. Your deposit, the moment you put it in the bank, is their money, legally. You do not retain ownership of the actual money. As it says there, you have only a contractual claim to get equivalent funds. Now, your money has been given to them and it is theirs. Okay. Legal relationship, debtor-creditor. The bank is the debtor, you are the creditor. The bank deposit, the bank equals the debtor, right? They owe you money, and you are the creditor. You lent money to the bank. Let that sink in. Again, most people don't think that that's the relationship. The legal relationship is exactly what I'm telling you it is. You have put money into the bank. You have given them a loan, and they have a legal right to use that money any way they want. It is not yours any longer. They do not have a fiduciary responsibility, as I was just saying, and they are not custodian of your money. So if they have a fiduciary responsibility, that's like when you put money in an escrow account with your real estate agent. They're not allowed to touch that money, and that is the case. They are not your fiduciary, and they are not your custodian. That would be like putting it into a bank safe deposit box, right? They're the custodian of that box, but they don't have the right to go in and get it or use it. Again, that is not the relationship you have with a bank when you put money in it. What this means, the bank can use your deposits any way they want. 2, and again, that's for lending or investing, and that's what they were doing in 2008 that brought the entire banking system down. They were using your money to invest in very risky things that brought the banking system down. Your deposits appear as a liability on the bank's balance sheet, not an asset, and it's money they owe you. So you're getting an IOU from the bank. You're an unsecured creditor. That is the legal term inside of Dodd-Frank. You become an unsecured creditor with no collateral backing your claim. Think about that. You've just given, whether it's $5, $50, $500, $50,000, $5 million, I don't care. You have just given the bank an unsecured loan with no collateral backing that claim. You have an IOU. How many of you would do that with me if I said, give me $50,000 with just a signature? Probably not, huh? Bottom line, when you quote unquote deposit, and it really isn't a deposit, money into a bank, you're actually making an unsecured loan to the bank. Let me reiterate, these are the words exactly as Claude gave them to me. That's why I've got the question up there in the top two. So you can go to Claude, you can go to ChatGPT, you can go to any AI model you want and look at these questions, see if you don't get the exact same answers. Okay? Now this is with Grok, so this is Grok's answer. No, you do not retain legal ownership of the deposited money in a standard demand deposit account. That's a checking account or savings account. Ownership transfers. When you deposit cash or equivalent into a general bank account, the title of the money passes to the bank. How many of you knew that? Key precedent. The principle comes from the foundational cases like Foley versus Hill in 1848. It's been that way for 150 years, folks. Okay? Now the second question. Does a bank owe me fiduciary duties like a trustee would? No. A typical bank deposit does not create a fiduciary responsibility. That's ChatGPT. Okay? What a bank is, for normal deposits, a debtor. The bank owes you money, not a custodian, not a trustee, not a fiduciary. Let that sink in. The bank is not acting for and on behalf of you when you put money into that bank, not as a custodian, not as a trustee, not as a fiduciary. They own that money. You have just given them, as I just said, an unsecured loan. Okay, this is Claude. No, banks are not fiduciaries. Bank account agreements contain language that says, quote, opening account does not create a fiduciary responsibility. So it's not just that someone's interpreting it this way, they actually put that language into it. So go read your deposit contract that you made with Wells Fargo when you dumped your money in there. You'll see that that is in there. So let's list what banks can do. A bank can use your deposits however they want, invest in risky assets, which they did in 2008, lend to anyone they want, make business decisions that benefit shareholders over you, the depositor. Okay? So that's what they can do. Again, if you want to ask yourself mentally, how do I know this is true? Just look at what happened in 2008 and there was no banker that went to jail. And then banks have no requirement to tell you any of this. And that's why you probably are hearing this for the first time. After filming this a few days ago, it became evident that I needed to change up the order of the questions that I had done. And so question number 14 has now become question 1.1. And that question is, when I deposit money in a mutual insurance company, do I retain legal ownership of my cash value, or does the mutual company own it? And these answers are going to be coming from Claude. So Claude said, short answer, you own it. Legal ownership. You are the owner. The cash value is your property. Listed as your asset on your balance sheet. You have contractual ownership rights, protected by state insurance laws as compared to federal. We'll explain that in just a second. And not subject to insurance company creditors. In other words, if the insurance company starts to go down, your cash value is still there. We'll see that in just a second because they have to keep it there. And unlike a bank, your deposits can't be turned into something that benefits the bank to keep it alive. All right. Insurance companies' roles. Your cash value is held as segregated reserves. This is not fungible and is not commingled like it is at a bank. In other words, you put a deposit in the bank, your monies get commingled with all the other funds that are in the bank. That does not happen with your cash value. Your cash value is held as segregated reserves. The insurance company cannot use your cash value for their debts or their operations, unlike a bank. Okay? Again, if they've got it separate in a segregated reserve, they can't touch it. You control cash value access via policy loans. And then Claude goes on to say this may reduce your death benefit. Well, Claude is not correct. It will reduce your death benefit. In my case, I have a death benefit right now worth about $1.2 million. If I borrowed $100,000 against the general fund of the insurance company using my cash value as the collateral, If I were to pass away after taking that 100,000 out, my wife would get 1.2 million less the 100,000, or in other words, 1.1 million dollars. So it's not may, it will. Surrender policy for cash value. In other words, you can stop the process anytime you want. You can quit, and you can ask the insurance company to give you back your cash value. You end the entire thing. You can also name the beneficiaries who are going to inherit your policy, tax-free. The cash value can be used as collateral for external loans. My wife and I used ours to purchase a home. We use that as part of our collateral. Insurance company cannot take cash value or restrict assets. So they have no access to your cash value. Now, where some people will get confused is the general fund of the insurance company. Remember, all of these companies that I've been talking about that are mutual companies have been around for 120 to 175 years. All of them have made profits during that time. And so the general fund of the insurance company is humongous compared to your little tiny amount of cash value. It's your cash value, though, that they have to have, as it said a minute ago, set aside, okay? And that's a statutory regulation at the state level, okay? So don't get those two confused. And the reason I asked that question specifically about cash value is because cash value would be more like the equivalent of a deposit that you think you have in the bank that you don't, because it's the cash value that after a number of years is bigger than the amount of deposits you've put in there. And it's acting more like a bank account, if you will, than the overall policy that has a death benefit, okay? State law protections. Most states exempt cash value from personal creditors, bankruptcy proceedings, lawsuits, and judgments. You need to check with your specific state to see what their state exemptions are. But let me ask you the question, why? Why would a state exempt personal creditors trying to come against you, or bankruptcy against you, or lawsuits against you, when you have a nest egg in there like mine? I've got $280 some odd $1,000 sitting in my cash value in just one of my two policies. Why would a creditor or bankruptcy or lawsuits be kept at bay from that $282,000? Well, here's the reason. This is still an insurance policy with a death benefit, all right? There are regulations that stipulate that these high cash value insurance policies still have to, as I say, waddle and quack like an insurance policy and not an investment. That's why I always say this isn't an investment, and not like a bank savings account, even though that's kind of what I'm talking about right now. But the thing is that this is still an insurance policy, and you bought an insurance policy with a death benefit for a purpose. And that purpose was to act as a benefit to your beneficiaries. So the reality is that the death benefit is larger than, right now, as I just pointed out, I've got about $282,000 in cash value, but my death benefit is $1.2 million. So it's 4x, if not 5x more than what I've actually deposited into my bank account, or into my insurance policy if I were to pass away right now. So my death benefit is going to be greater than, and more important to state regulators, than the cash value. So although you can use the cash value, as I'm saying, as a bank account, right, a large long-term savings account, the courts have said, well, wait a minute. Eric got that policy so that if he passes away, his wife and his heirs get that money, that death benefit, which again is 4 or 5x more than what the cash value is. And so that's why the courts have exempted getting a hold of your cash value in your policy if there's any personal creditors coming after you, a bankruptcy, lawsuits, or judgments. Again, all of this is dictated at state level laws, so you'd need to go and look at your specifics. But in general, that's how states look at this. Okay? Now, this is the answer that Grok said. In a mutual company, when you pay premiums that build cash value, you, the policyholder/owner, retain legal ownership. You also get access to cash value via tax-free policy loans. We just saw that. You can borrow without repayment requirements. Keep in mind that the mutual life insurance company does not own your cash value. It holds and invests the funds to support your guaranteed cash value, your growth, and death benefit. The insurer acts as a custodian manager, okay? That is very different than what we just saw with a bank. The bank doesn't act as your custodian or manager. But title and beneficial interest belongs to you. I want to talk real quickly about the guaranteed cash value. When you have an insurance policy, you're going to have on the illustration a column that shows your guaranteed cash value, and then in another column, the guaranteed cash value plus the dividends, and they'll call that the non-guaranteed side of your illustration. Now, why do most insurance agents like myself focus on the non-guaranteed side, which again is the guaranteed amount of interest you're going to get paid on your policy, as well as the dividends that are going to be paid out? The reason is all of the companies I've been talking about, or all of them that I work with, have been around for at least 120 years, some of them upwards of 175 years, and every single year without fail, they have not only paid the guaranteed portion, but also a dividend. Important point, if you're thinking about this as a bank account, as a long-term savings account, because you have they have a contractual obligation. The mutual company has a guaranteed obligation to pay you at least the minimum amount of interest that they're saying is going to be in the insured column, in the guaranteed column of your illustration. The reason I had to move 1.1 was so that I could answer 1.2. So you said the federal government can't regulate or confiscate funds deposited with an insurance company, and said this is protected by the U.S. Constitution. That surprised me. I wasn't expecting that answer, and it came up in one of the replies. But aren't both bank deposits as well as insurance premiums being protected through contracts? What makes these contracts different? And why do insurance company contracts protect deposits from government confiscation, yet bank contracts don't protect deposits from federal confiscation via Dodd-Frank? Now, this answer is going to come from Claude. That's a layered question that touches on contract law, constitutional law, corporate structure, and federal regulatory jurisdiction all at once. So I've just boiled this down to make it simple. Why are insurance company deposits protected from confiscation and bank deposits are not under Title II of the Dodd-Frank Act? The bank deposit relationship. You are a creditor, not an owner. When you deposit money in a bank, the legal reality that most people don't understand is that you no longer own that money. The bank does. I know we've hit this home, and I'm going to continue to pound on it. Legally, you are a bank's quote-unquote unsecured general creditor. You hold a debt claim, essentially an IOU. Okay, this is why Congress, through Dodd-Frank's Title II, and it's called the Orderly Liquidation Authority, or you'll often hear it just called OLA by those that are talking about it, can restructure. Again, restructure is a euphemism for liquidation, so they can liquidate or bail in those debt claims. You are not having your property taken from you in a constitutional sense. Why? Because it was already taken when you deposited an unsecured loan to the bank, right? You're having a debt claim or deposit modification, which falls squarely within Congress's authority over commerce, banking, and insolvency law. The FDIC guarantee is a statutory protection. It's created by Congress, meaning Congress created it, and thus Congress can modify or limit it. The Orderly Liquidation Authority can restructure or bail in your debt claims. When the FDIC Deposit Insurance Fund is gone, and the next little brackets is mine, that's $137 billion to cover $10 trillion in deposits, you are in line with other unsecured creditors. Let that sink in, folks. When the FDIC's Deposit Insurance Fund is gone, which is currently, I believe, about $137 billion to the $10 trillion that it's backing up, you're in line with other unsecured depositors. And I believe, if I remember the math correctly, that's about 1.3% of the total needed if there's a banking crisis. All right, the mutual insurance relationship. And again, don't get this confused with a stock-based insurance company. This is only a mutual insurance company, and I don't work with stock-based companies. You're an owner, not a creditor. This is where the structural difference is profound. You're a member owner of the insurance company. The cash value and death benefit are not a debt claim the insurance company owes you. They represent your ownership interest and contractual property rights within a mutual structure. So if the term mutual insurance or mutual structure isn't familiar to you, what it's saying is kind of like a co-op or a fraternal organization, right? You are part of an organization that exists for and behalf of its owners and policyholders who are one in the same, okay? Policyholders collectively own the company, share in its surplus, and receive dividends. Several constitutional protections are at play. One, the Fifth Amendment, the taking clause, as it is known. The government cannot take private property without just compensation. Because your interest in a mutual company is a property right, an ownership interest, not merely a debt claim, any government action that impairs or seizes that interest would constitute a taking requirement, and therefore just compensation on the government's part to give you it back. Not like what they did in Cyprus, where people got wiped out, 47.5% gone immediately, and then 52.5% became worthless stock in a new bank. Bank deposits don't receive this protection in the same way because you don't own the money, the bank does. Another constitutional protection is the Contracts Clause, Article 1, Section 10. This prohibits states from impairing the obligation of contracts. Since insurance is primarily state regulated, state legislatures cannot pass laws that retroactively impair your policy contract. I mean, think about that. If a state tried to impose a law on an insurance company, how many of those policies have been in force for over the last, say, 40, 50, 60 years, right? The Supreme Court has historically interpreted this as a strong protection for vested contractual rights, particularly those with long-term reliance interests like life insurance policies. My father told me that one time. He said, you know, the best investment I ever made was the insurance policy that I bought from my cross-country coach at Harvard. So, you know, that thing, like I said, it's been in force now for nearly 70 years, okay? All right, here's another one. McCarran-Ferguson Act of 1945. Now, this is called the Federal Hands-Off Rule, the most practically important protection that keeps the federal government from ever reaching in and using your cash value to keep an insurance organization solvent like it does with banks. Congress explicitly ceded primary regulatory authority over insurance to the states and prohibited federal laws from preempting state insurance regulation. This means Dodd-Frank's bail-in powers do not reach insurance companies. The federal government built Dodd-Frank Title II and deliberately excluded insurance from it. McLaren-Ferguson backs that exclusion up. All right? Another one is the 10th Amendment, which is the reservation of powers. We've all heard this one about the 10th Amendment, that the 10th Amendment reserves to the states all powers not delegated to the federal government. Insurance regulation is one of those reserved powers. What matters constitutionally is what the contract actually conveys. With a bank deposit, a contract conveys a debt claim. We've talked about this. Congress can legislate around a debt claim with its commerce and banking powers. With a mutual life company, the contract conveys a property interest in an insurance company itself. Guaranteed statutory reserve protections, and I just got through explaining those with the two different things that you'll see in the illustration, the guaranteed portion and the non-guaranteed, which is the guaranteed portion plus dividends. That's the non-guaranteed portion. Okay, so property interest in the insurance company itself, the guaranteed statutory reserve protections that every state imposes on insurance companies, and contractual rights that predate modern federal banking regulation. Now, I'd like to show you, if you're wondering what modern federal banking regulation is all about, I'm going to put you into a meeting here for a couple minutes, and you're going to listen to the FDIC discuss Title II of Dodd-Frank and how much information they think you deserve to hear, okay? So here it is, a modern federal banking regulation being discussed in public. You tell me, do they care about your interest as a depositor?
There are a lot of things we've been thinking about, and what we want to hear from you today is what you think the priorities would be in order to go about setting expectations appropriately in public about how we would execute Title II, so that if and when we do have to have that announcement on Friday night, ideally Friday night, that people are in a position to receive it, understand it, and say, yeah, that works. And we can see how this will happen. Of course, there will be doubters, but there's a lot of things going on. So with that.
I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis. And this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments. And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in, they're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Okay, question number 3, still with Claude. On a bank's balance sheet, where do customer deposits appear? On the asset side or the liability? Customer deposits are liabilities for the bank. So what are their assets, right? What are the assets from a bank? We can prove this. Assets are what a bank owns, and these are the assets that a bank owns. Loans made to borrowers. So when you get a mortgage, they put on their asset side the fact that you owe them $400,000 for that house you just purchased, right? So that is an asset to the bank, unlike your deposits. Investments, bonds and securities are also their assets. Buildings and equipment are also a bank's assets, and Tier 1 cash reserves. By the way, I'm just going to point this out. Cash reserves, Tier 1 cash reserves. So there's Tier 2 also. Tier 1 is what they used to use as reserves for lending. They no longer have to. Well, there's still capital requirements. So let's just call it their capital requirements. Tier 1 capital requirements are cash, so like equities they have in the bank from the stock people have purchased. 2, gold held in their vaults. So not paper, that like a bet that most of us buy when we buy gold online. You're buying a bet of the cost of gold in the future, and that's just a paper bet. There's no real gold, so it has to be gold in their vaults. And 3, for most of you, you've never heard this or know it, but also high cash value insurance, cash value. Why? Because the banks have legal access to that at any time they want. It's called BOLI, bank-owned life insurance, and most banks own between 25 and 40% of their Tier 1 assets in high cash value insurance. They put it on their employees, managers and above. And so those are the folks that they're insuring their lives, and that is also a Tier 1 asset. So that's what's an asset for a bank. And notice that your deposits were not an asset to the bank. They're actually a liability. It's what they owe you. All right. Oh, and there it is. Equity, gold, and insurance cash value. Okay. Legal implications. If deposits were your property being held for you, they'd be off the balance sheet entirely. Like money put in a safe deposit box. Right? You take grandma's diamond ring, right, and you put it in the safe deposit box. That's not something that goes on the bank's assets or liability side, right? It's just a box there, and they're holding it as a custodian. Note, your money is on the bank's balance sheet as a liability. It's not off the balance sheet completely as it would be if they were actually just holding your if they were just holding your deposits, like a safe deposit box and its contents. I just said that. Okay. Question number 4, and this again is with Claude. What is Title II of Dodd-Frank Act? What authority did it give the FDIC regarding bank failures and liquidations? If you want to look up the term, it's called OLA. That's what you'll hear them say in their meetings and such, but it means Orderly Liquidation Authority. Now, they're going to say receivership all the time, too. Remember, receivership is just a euphemism for liquidating a bank. Okay, so they have the Orderly Liquidation Authority. It's the legal framework to resolve too big to fail institutions. Okay, the new powers were given the FDIC in 2010. One, authority over all major financial institutions. So what they call those is significantly important financial institutions, SIFI. Power to liquidate without bankruptcy court. Again, these are quotes from Claude. Authority to convert unsecured debts to equity. What does that mean? That means when they use their orderly liquidation authority, they'll announce it on Friday night. The FDIC will announce that they've become the receiver of a bank, or in other words, the liquidator of a bank. That bank will be put into not bankruptcy because they don't need it to be in bankruptcy. They will create a new entity. They will fire the old management over the weekend. They'll create a new entity. They'll wipe out all the debts, and then they're going to take, except, well, some of it, your unsecured debts, which again, we just showed that you are a creditor of the bank. And what they're going to do is they now have the authority to call your debt, all that money sitting there that depositors have put in there is theirs. They then take that money and they use it to save the banking institution, and then they give that money, they turn that money into equity. So Friday, they're going to close down the bank. Monday, you're going to wake up knowing that if you had $100,000 in there, you might have $50,000 worth of quote unquote equity in this new bank that they've just created. You lost 50% of the value of your deposit immediately, and they gave you $50,000 of worthless stock in a brand new bank that almost went bankrupt over the weekend. That's what legally happens with the FDIC, Orderly Liquidation Authority. English. Okay. Number 5, what is a bail-in versus a bailout? This is ChatGPT's answer. A bailout, the government injects outside money, taxpayer money, used to stabilize a failing institution. Losses are absorbed externally, i.e. you and I as the taxpayer, globally. And an example, the 2008 crisis and interventions. So that money, it bailed it out. That's why they created Dodd-Frank, right? Is the taxpayer said, no. The bankers did risky things. They put their organizations at risk, and we don't want to incur that risk ourselves. So that's what Dodd-Frank came about. But what they did is they created a bail-in. Again, this is ChatGPT. So a bail-in. Losses are absorbed internally, in other words, within the bank itself. Shareholders are wiped out first. Then unsecured creditors. That's those of you that have over $250,000 in deposits. Again, we keep calling it a deposit, and I know that the banks call it a deposit, but the reality is when you think of it as a deposit, you're thinking that's my money. And as we just clarified, it isn't. You've given them a signature loan. It's their money. They own it. That you have an IOU with the bank, and that is it. Okay? It converts your debt, your IOU, into equity, or it writes it down completely. Okay, and I'll give an example of that happened in Cyprus. Grok, this is their answer. Bailout, government or taxpayer provides the funds to rescue a failing institution. A bail-in, losses absorbed internally by the firm's shareholders and creditors, that's you and I as depositors, to recapitalize and stabilize a new organization. I know it says it, but what it's saying is the new bank that is created by the FDIC over the weekend. Okay, here's what Claude had to say. Bailout, the old way, was pre-2010. External rescue, government or taxpayers. Bail in, the new way, post-2010. Internal rescue, creditors and depositors. Title II gives FDIC legal authority to use deposits over $250,000 to absorb bank losses. All right, think about that for just a second. If you've got 250 or more sitting in a bank, it's probably because you're an entrepreneur. How many of you entrepreneurs have started a business and had it fail? My wife and I did. We bought a roller rink, and it failed spectacularly, right? But who didn't come to bail me out? The federal government. They didn't say, oh, well, that little roller rink in Corvallis, Oregon is so important to that society that we're going to keep it alive. No, banks hold this special value, and we're going to talk about what that value is. And most people never talk about this either. We're going to talk about what makes banks so valuable to the U.S. economy that the federal government is willing to take your deposits and keep that organization alive in your community. I'll explain that in a minute. But that's a specialty that no other business has. Question number 6. What happened to bank depositors over 100,000 euro in Cyprus in March 2013? What percentage of their deposits did they lose? So I know some of you, I told a friend I was making this video and he said, they're never going to do that. In other words, they're never going to enact the powers they've been given in Title II to confiscate depositor funds. Remember, with only 3 banks failing in 2023, that was such a huge issue that systemically the government jumped in and saved them, right? Because it would have hurt the financial institutions. So this is what actually happened in 2013 in Cyprus. This is the answer from Claude. What happened? Cyprus banking system collapsed. It had too much debt. Oh, where have we heard that before? What's America at right now? $38 trillion in debt? More debt than anybody? And this is what caused Cyprus to fall, just saying. Cyprus banking system collapsed because of too much debt. Government needed about 10 billion euros for the bailout. The EU and the IMF demanded depositor bail-ins. In other words, they weren't willing. Neither the IMF nor the EU were willing to take that risk. And so they just said, well, sorry, we're going to use that bail-in clause that everybody now has in their banking system. First-time depositors were used to save a bank. All right, the losses. The Bank of Cyprus, and there were two banks in Cyprus that fell. This was the biggest one. Depositors over 100,000 euro, they confiscated 47.5% of that money. Gone. Psst, over. Example, 1 million euro deposit meant they seized 525,000 euros from that person. Remaining was 52.5%, and that was converted to equity. In other words, worthless stock. That's what it says. That equity later became nearly worthless stock. So you wake up on Monday morning to find out that 47.5% of your deposit is gone completely, and what you have left is 52.5% in equity. In other words, worthless stock in a brand new company that was created over the weekend. The losses. This is the Laiki Bank. That was the second bank that collapsed. It was completely liquidated. The bank was shut down. Depositors lost 100%. Let that sink in. This has already happened. So for those of you that said to me, they'll never do it, well, they have the power to. And again, who is making the decision? And that was the interesting part to me. The EU, who are unelected officials, and the IMF, unelected officials. Total wipeout. All right. The timeline. March 15th, 2013, the banks closed, no ATMs available. And you couldn't go in with your app on your phone either and move monies. March 18th, so 3 days later, it was declared a bank holiday and it was extended. On March 28th, so we've gone almost 2 weeks now, the Cyprus bank reopens. Deposits over 100,000 euro already confiscated. So you had nothing that you could do for 2 weeks. How many of you could continue your normal business operations with no access to your banks for 2 weeks? Even if they didn't confiscate your money, how many of you could handle having your bank closed for 2 weeks and have no operations taking place? Capital controls. They cannot move money out of Cyprus. Let me reread that one. Capital controls. In other words, that 52.5% that was still sitting in your account that you couldn't get at, it was just a number on the screen or on your phone, but you couldn't actually touch that money. It also had, as they began to loosen up and let you get some of that out, again, it took 5 to 6 years to get all of it, those capital controls prohibited any money from leaving Cyprus. Think about that. I don't know if any of you have read any of Ray Dalio's books or watched his videos. And if you haven't, I would highly recommend that you go look up Capital Flight and Ray Dalio and find some of them. Those are my books right there from my library. And this was Gemini AI. And what he calls it is capital wars. And they trigger structural shifts away from the US dollar, asset protection. He's saying that's what we need. So hard assets, metals and land. And maybe I'll just tell you right here, this is what I do. So when I get paid, I shove my money into my insurance policy so that my death benefit grows. And so all of that is now growing at 5.75% for the rest of my life. And then I borrow back the part that I want, and I'm investing in silver and gold and land. So that's where it's happened. We're going to jump to question number 7 now. And this will be, again, the answer from ChatGPT. Does FDIC insurance reduce or increase risky bank behavior? As I said, it's about 50-50. I looked up Wells Fargo. They have 55% of their deposits are from insured depositors, so less than 250,000, and 45% are the uninsured depositors. Why insurance can increase risk, or what's called moral hazard. The insured depositors have little incentive to monitor the bank risk. Think about that. We've always been told banks are safe. We don't think about what the banks are doing. We just give them our money. Again, most of us don't understand that when we give them our money in deposit, they are not acting as our fiduciary, nor are they acting as our custodian. We've given them a loan. I'm going to beat that home, okay? Less reason to withdraw funds early because they're not worried about it. Oh, I'm protected by the FDIC. Reduced market discipline from small depositors. Now, those small depositors are not requesting of their banks more discipline with what they do. If losses are occurred, FDIC fund absorbs insured losses. Shareholders limited to equity loss, right? This is the classic moral hazard problem in the banking theory. Grok, this is what they had to say. FDI insured 250,000 creates a moral hazard that generally enables banks to take more risk, not less. This is the direct quote from Claude. Short answer, FDIC insurance enables banks to take more risk, not less. Depositors stop monitoring. My money is insured, it's not my problem. Academic research shows, studies show the FDIC insured banks take significantly more risk than uninsured institutions. I've highlighted that because I get that question all the time. But Eric, is my money safe with a mutual insurance company? And we're going to talk more at length about that. But notice what it says there, significantly more risk than uninsured institutions. Uninsured institutions have to answer to their depositors. So they don't do the risky stuff that causes failure, period. They keep more reserves on hand, period. That is why they're safer. And it just said that by Claude. I thought that was an interesting comment there. I like what it says there. The perverse results. The safety net, in other words, the FDIC insurance, meant to protect depositors actually enables banks to gamble with their money, making them a more risky place to save your funds. Okay, number 8. What do banks actually do with customer deposits? Explain how fractional reserve banking or credit creation. See Richard Werner and his works. If none of you have seen or watched the video called The Princes of the Yen, it's in English, it's out on YouTube, watch it. Okay, here's the myth. This is what we've all been taught and this is what we think. Bank takes a $1,000 deposit. It keeps some of it in its vault and it lends the rest out to borrowers. And that your money physically goes to somebody else. The reality, as Dr. Werner's proof, you can find other shorter videos about him explaining this theory, is that bank creates new money every time they create a loan. Your deposit stays on the books as your liability. In other words, that liability isn't wiped out as they lend it to somebody else and then turn that loan into an asset on their bank sheets. That's what they were looking for. Remember, we've already talked through this. So you are owed money and it's here on the ledger as a liability to the bank. And so if when they lent out a portion of that $1,000, that would then become an asset because they've lent money to a borrower out there, and that borrower now has an IOU to the bank, and that IOU to the bank is considered income to the bank. So it's an asset, even though it hasn't been paid yet. And that's what it's saying there. Your deposits stay on the books as a liability. They aren't reduced by the amount that they make with a new loan. Simultaneously, then the bank creates with just a ledger entry, the new loan and the new deposit. So the new loan that goes to the borrower and the new deposit that is then in the bank account of the person that borrowed it. Because that's how the bank gives you your money, right? They dump it into your account. So they have a new liability and a new asset. That's what they do. They didn't use your money at all to make that loan. Money is created out of thin air through accounting entries. Now, I know we've been told that that's what the Federal Reserve does, and you hear the people that follow Ron Paul scream about the Federal Reserve all the time. But the reality is the banking system is making about 97% of all new money in our economy. That's why even one failure can really disrupt the economy. And it's why SVB, Silicon Valley Bank, was such a risk, because that's where there was millions upon millions upon millions of dollars that were the lifeblood of venture capitalist new companies, right? New startups. And that could hurt our economy. And that's one of the reasons that they were saved. All right. Again, the proof. Banks create, there it is, 97% of the money supply through credit creation. I hope I've explained well enough how that works. Only 3% in physical cash is created by the central banks. Every loan is new money added to the economy. Inflation. Fractional reserve banking, on the other hand, which is what we were told as kids, is that the reserve requirements, and those were historically 10%, they're now down to 0 post 2020, but we were told that they had to have 10% left there. So the numbers they're going to show you is what fractional reserve banking was prior to 2020. Okay, so a bank holds 10% of quote unquote your deposits, but they don't. We just saw that they just create money anyhow. Then they can lend the other 90%. That's what we've been told all our lives, and that's a lie. But that's still, they do still have capital requirements, and most banks do keep between 12 and 14%. So although it's fictitious, and a lie that they're actually using your money, which is what we just showed, that your money stays, the entire amount stays there as a liability, and they just create a new entry. So they have two entries, a liability and an asset. That's how they create money. But they didn't have to touch your money, and it didn't get affected in any way, shape, or form. So the bank holds 10%, but they still do because they have capital requirements. So that part of it's true. And they can lend and create credit with the other 90% credit creation. So under the fractional reserve banking theory, your $1,000 deposit allows the bank to create $9,000 of new money. All right, so this is the current reality post 2020. The reserve requirement is now zero. The Federal Reserve eliminated reserve requirements in March of 2020. Okay, the bank can now create unlimited money from deposits, and the only thing that's going to restrict them then is, the kind of borrower they're willing to lend to. No legal limit on credit creation, in other words, lending. Even more leverage, they can do it with zero. Even more risk to the bank. Modern banking works through balance sheet expansion. There's a euphemism for money creation out of nothing. Expansion. Asset equals loan receivable of $100,000. Liability, new deposit in borrower's account, another $100,000. Those are the two entries that get created when somebody borrows money. And your liability doesn't change at all. That's what we were saying earlier. No prior depositor's money is moved. That's what we were saying also. So ChatGPT is also telling us the same thing that Claude was telling us, okay? The bank creates a new deposit at the moment of lending. This supports the credit creation framework. See Dr. Richard Werner. Question number 9, and this will come from ChatGPT. In 2023, when SVB, Signature, and First Republic banks failed with a combined $549 billion in assets, did the FDIC have enough money to cover the losses? ChatGPT says 2023 bank failure, SVB, Signature, First Republic combined assets were about $549 billion. FDIC Deposit Insurance Fund had $128 billion. Let that sink in. 549 versus 128. The reserve ratio for total deposits out there in the economy is about 1.27%. Grok gave this answer. No, the FDIC's Deposit Insurance Fund did not have enough money to cover all losses from the 2023 failure of SVB, Signature, and First Republic banks. $549 billion in assets without intervention or special measures, particularly from uninsured depositors. Bottom line, without the systemic risk exemption for SVB and Signature, I just explained why that was, because they had so much money in startup companies in Silicon Valley, and structured sale, First Republic was bought by JP Morgan Chase, I believe, and they were given the money by the federal government to make the purchase of that failed institution. Uninsured depositors would have faced losses in standard least cost resolutions. The Deposit Insurance Fund alone couldn't absorb the full uninsured exposure of 3 banks, okay, without these interventions or industry assessments. Okay, question number 9. Again, the same question, this time it's with Claude. 2023 bank failures, FDIC fund adequacy. Short answer, no. The FDIC Deposit Insurance Fund was completely inadequate. The math. The Deposit Insurance Fund had $128 billion. We just saw that. The assets that were at risk were $549 billion. That's a shortfall of 4x of insufficiency. What the FDIC fund had to do, invoke the systemic risk exemption. Thus, they had to declare that these failures threatened the entire financial system. Think about that. 3 of the, 4,000 or 5,000 banks we have in America failed, and that was enough to say that that failure threatened the entire financial system of America. You know what? Go back to my example of the roller rink that failed, right? Can you imagine the federal government saving my little roller rink in Corvallis, Oregon, because my little roller rink threatened the roller rink industry across the entire nation? Absurd, isn't it? Nobody saved my butt. Protect all depositors, even over $250,000. Cost far exceeded the DIF balance. Emergency government intervention, which is what Dodd-Frank was supposed to be there to eliminate, was emergency government intervention. Special assessments on other banks. JP Morgan bought First Republic with government assistance, as I just got through saying. So, if the FDIC had stuck to the rules created by Dodd-Frank, 128 billion in fund versus 549 billion in failures, the fund would be completely depleted, Uninsured depositors over 250,000 would face bail-ins. And why they broke the rules? Fear of bank runs nationwide. Oh my gosh, if we don't save Eric's roller rink in Corvallis, Oregon, kids will quit roller skating across the nation. We must save his roller rink. No, they didn't come and do that for me, did they? Nope, I lost it. But if one bank in Silicon Valley is allowed to use bail-ins, guess what that rich retired farmer in Iowa might do? Pull his money out of the banking system too, and that's what they were worried about. Tech industry meltdown, they were worried about that, which again would have really caused a problem in the United States, right? And then I got a real kick out of this one. Not too big to fail, too many to fail simultaneously. And how many banks did that take in 2023? Three banks. 3 roller rinks in America are struggling. Oh my gosh, the roller skating industry is going to fall apart. We must save it. But 3 banks failing simultaneously meant the federal government had to step in. Without government intervention and breaking their own rules, the banking system would have fallen apart. Okay. Without government intervention and breaking their own rules, the Deposit Insurance Fund would have been wiped out in 48 hours. Again, that is a direct quote from Claude. All right, question number 10. As of the latest published date, what is the amount of funds in the FDIC Deposit Insurance Fund, and what are total deposits they cover? What percentage of the total deposits are covered? Deposit Insurance Fund, fourth quarter 2024, I guess that was the latest they could find. The DIF fund is $137.1 billion, so it's up from what it was in 2023. Okay, insured deposits, about 10.7 trillion. So the Deposit Insurance Fund divided by the insured deposits is 1.28%. All right, the next question, number 11. How many FDIC insured banks have failed in the United States in the past 25 years? How many mutual life insurance companies have failed in the past 175 years? That's a fair comparison, right? The last 25 years versus the last 175 years. Again, it's because I get the question all the time, well, how safe is putting my money in an insurance company if I don't have FDIC insurance? Okay, this is the answer that ChatGPT gave. 571 FDIC insured banks failed between 2001 and 2026. Mutual life insurers that failed in the past 175 years? 0. Mutual benefit life insurance companies ceased, and they failed in 1991. So, again, we find discrepancies with these AI models because it just told us there were 0, but then it gives us beneficial life insurance. And one of the other ones, or maybe it's this one, does explain what happened there. But there was one, so it was beneficial life. National Organization for Life and Health Insurance, their Guarantee Association, many insure insolvencies since 1983, but they were not mutual life. And notice that I said mutual life. Mutual life insurance companies are not stock-based insurance companies. I will explain the difference between them, but I do not put my clients into stock-based insurance companies. I put them only into mutual companies. So yes, there have been insurance companies that went down. AIG, $182 billion because of the derivatives they bought. But we're not talking about that. I'm asking only about mutual insurance companies. Claude tells us the same thing. Total bank failures were 571. So between 2000 and 2007, the pre-crisis, 35 failed. 2008 to 2011, during the crisis, 400 failed, 70% of all the failures. And 2010 alone, 157 failures. That was the worst year. Between 2011 and 22, they had about 31 failures. And in 2023, 5 failures, 549 billion in assets. The average 23 banks fail per year. Okay. Major mutual life insurance companies in the past 175 years, again, that have failed. Well, there you have it, folks. Northwest Mutual did not fail. They've been around 168 years. Penn Mutual's been around 178 years. Mass Mutual's been around 174 years. New York Life has been around 180 years. Guaranteed Life, 165 years. Lafayette Life, 120 years. Mutual Trust, 121 years. Number of failures, 0. The one exception was Mutual Beneficial Life. Again, this is Claude. That failed because it abandoned mutual principles, invested heavily in junk bonds, stock-like risk-taking, made speculative real estate bets, pursued aggressive growth instead of stability. The lesson, when mutuals act like stock companies, they fail. So the crisis comparison. The Great Depression, 1929 to 1933. Number of banks that failed, 9,000 banks. Now, think about that for a second in light of what we just saw with the FDIC Deposit Insurance Fund being able to cover, even with the extra $100 billion that they could get from the Treasury, only 2.21? Let's just round it up to 3% of total deposits. What if they had 9,000 bank failures? You saw what happened with just 3. So the mutuals had 0 failures during the Great Depression. Minor note, some small insurers failed, but not the mutuals. So again, they're finding evidence that some insurance companies failed, but not the mutual insurance companies. And once again, I have never in 10 years put a single client into a policy that was a stock-based company. Again, from Claude, crisis comparison, 2008 financial crisis. Banks needed bailouts, dozens. Citibank, B of A, and Wells Fargo. Mutuals needing bailouts, 0. Continued paying dividends. The stock insurers were bailed out. AIG, 182 billion, Hartford, 3.4 billion, Lincoln, 950 million. That's what stock-based insurance companies had to be bailed out. Okay, so the crisis comparison, major mutuals have perfect track records spanning the Civil War, 2 world wars, the Great Depression, and the 2008 crisis. Not one needed a bailout, not one failed. So for those of you that ask me that question, is it safe to put my money with a mutual company? Yeah. Okay, question number 12. Could it be argued that major differences between the financial institutions that needed to be bailed out and those that didn't is their organizational structure? In other words, stock-based versus mutual companies. The first answer comes from Claude. Mutual companies, no bailouts needed. Who they serve? Policy holders. That is different than a stock holder, a policy holders. And they are also the owners and the customers. So those two are combined. Ownership in the company and customer are combined. So those interests are not divorced as they are in the stock world. Okay? The behavior equals conservative, low leverage ratios. Okay? So here's a little chart that kind of shows the difference. The ownership in a stock insurance company is the shareholders own it. In a mutual company, the policy holders own the company. What a stock company wants to do is maximize profits. What a mutual company wants to do is maximize stability. What a stock insurance company wants to do is get high returns, and what a mutual company is willing to take are low but safe returns. Maximum allowed, the leverage is what the stock insurance company, in fact, that's what AIG was clamoring for during the 2008 crash, was to realign the leverage amounts or re-legislate the leverage amounts because they're right now at 100%. You have to have 100% deposits there, and they wanted that to be minimal. So, and then the mutual companies, they were conservative. Derivatives, heavy use, minimal to none. 2008 bailout, billions needed, 0 for the mutual companies. Bottom line, yes, the fundamental difference is organizational structure. Stock companies serve shareholders, they take risk, and they needed $1 trillion in bailouts. Mutual companies serve policyholders, they stay conservative, and they needed 0 in bailouts. The 2008 crisis was a perfect natural experiment proving that ownership structure determines behavior, and behavior determines survival. When the owners are the customers, as I said, those two are together in a mutual company, the companies act conservatively. When the owners are Wall Street and investors in a stock company, the companies gamble, and that gamble hurts the policyholders. So that's the issue there. Stock insurance, the stock structure plus the profit maximization equals bailouts. With the mutual structure, the policyholder protection is the most important, and therefore it provides stability. Okay. Question number 13. Explain the fiduciary responsibility of executives and to whom are both stock-based and mutual companies beholden. This is the answer from ChatGPT. Mutual insurance company owned by policyholders, no public shareholders, profit returns as a dividend to the policyholders and increased surplus. Long-term contractual business model. We're comparing that then with a stock-based bank or a stock-based insurance company owned by the shareholders, publicly traded, usually, profit distribution via dividends to shareholders, which are taxable, and stock price appreciation, quarterly earnings pressure. How this affects decisions. And this is the question that the executives at a mutual company are asking themselves. Will this protect our policyholders for the next 50 years? Again, I'm not arguing that banks aren't needed. What What I'm saying is, if you need checking functions, a checking account function, then use a bank, right? You're moving money in, you're moving it out. That's fine. We're talking about a safe storage, like your savings account, like your CD account. That's what I'm talking about here, instead of using a bank. And again, the mentality of the executives at a mutual company is, will this protect the policy holder for the next 50 years? All right, here's the last question, and this is probably the best one. Compare one-time $1 million deposit over the past 25 years in 3 different locations. A bank CD earning 4%, a mutual insurance policy earning 5.75%, because that's what I'm making with mine. The actual Dow Jones year by year for the last 25 years, as we've said a number of times today, the mentality at a mutual company is a 25 to 50 year horizon. That's why I chose that, okay? If you had to choose which storage facility wins, again, not checking account, not investment. We're talking storage facility of your money. But notice I'm pitting it against what we always get told. Oh, well, the Dow Jones did 9%, or I've got a mutual fund that does 11%. Okay, well, watch what happens here. Okay, here we go. Starting 25 years ago, in the year 2000. That first year, you may recall, because of what happened that happened in 9/11, huh? We had a negative 6.8%, so your million has dropped from $1 million to 940,000. Whereas your bank CD went up by 4%, so it's at $1,030,000, and your whole life insurance went up by 5.75, so you have $1,057,500. In 2001, again, the Dow went down by 7%, and in 2002, the Dow went down by 16%, and in 2003, we finally got a huge rebound, but you'll note that even with that jump in 2003, your million is still only worth $916,000, okay? All right, let's move to the next 5 years. So 2006 to 2010, we had a negative, as we know, in 2008 of negative 33.84. So notice here, the Dow had taken your million, and you were now up to $1,172,000. But and I think it was just a handful of months, the Dow dropped by 33.84%, taking your almost 1.2 million down to $770,000. Okay, whereas your boring investment of the CD and the whole life are still just trudging right along. 2011 to 2015, again, we got to a high in 2012 of 1,169,000. This is the first time that the policy has gotten back to where it would have been if we hadn't started out with those negative 3 years. So, but at the same time, the whole life is at 2 million. If we go to 2015, it's now grown, your brokerage account has now grown to 1.5 million, but your whole life policy is at 2,443,000. So almost $1 million more in just 15 years. 2016 to 2020, again, at the end of that 2020, you've got 2.7 million in your brokerage account. You've got 1.8 million in the CD. So it's fine. The brokerage account is finally beating the CD, and your whole life is at $3.2 million. Between the last 4 years, 2021 to 2024, again, all good positive years for everybody there. Your brokerage account is now at $3.8 million. Your CD balance is at $2.1 million, and your whole life insurance has grown to $4 million. I want to make a comment there. Keep in mind, that number is the cash value that you have in your account. Your death benefit after 25 years is still going to be 2 to 3x more than your cash value. So your death benefit's probably going to be somewhere between $8 and $12 million if you were to pass away after those 25 years. So keep that in mind too. So as a pure savings account, you've beaten what many would say was a safe investment by investing in the Dow. So here's the 25-year final results. Notice, estimated fees for your whole life policy. I want you to think about that one right there. 0, okay? That is an important number. Your whole life policy has 0 fees. Estimated taxes, they are also 0. As an insurance agent, as a commission, it's front-loaded. But I get my commission up front. And then after that, for the next 25 years, that's your policy. Okay, they're not dinging you. I'm not like your broker that's getting 1.5% money under management every single year. That's why it says the estimated fees and the estimated taxes, because it's also the place where it grows tax-free, which is why America's CPA, as he's called, Ed Slott, says that the tax benefits of whole life insurance are the best in the entire tax code. So 0 fees, 0 estimated taxes. Okay, on your brokerage account though, estimated fees, $900,000. Oh, wait a minute here. Your broker just made $900,000 off of you over the past 25 years. Yeah, now you know why when you go talk to Edward Jones and you tell them that you want to put your money into a mutual fund or gold or silver or whatever other thing you want to put it into other than the stock market, they're going to have a conniption fit because they're going to lose $900,000 on your million over the next 25 years. Whereas that's not my incentive. So the net gain for the whole life was $3,041,000. The net gain for the brokerage was $2,880,000, and the net gain for the CD, you still had taxes of $450,000, but your net gain was $1.1 million. So, all right. Here's the shocking discovery, says Claude. I thought that was funny that Claude would use the word shocking discovery. Whole life beats the brokerage. I guess even this inanimate object was surprised by the fact that the whole life boring, steady bank account did better than investing in the Dow. Whole life beats the brokerage after 25 years, starting at 2000. Whole life, $4,041,000. That's the winner. The brokerage, $3.8 million, and the bank CD, $2,115,000. Whole life averaged $158,000 more than the brokerage. Now, and yes, the gentleman I'm thinking of makes tons of money investing it in companies. He's got a gold thumb on creating companies as an entrepreneur. That's where the majority of his investment should be, admittedly. But there's still no reason why he shouldn't have a portion of his liquidity in something that's safe. And that's what we're talking about here. Where to put a portion of your liquidity in a safe place that you know will be there and know how much it'll be in 25 years. Okay. So here's the tax burden comparison. Total cost for the brokerage was between taxes and fees, $1 million. That's why the world that we're living in today pushes moving your money into the stocks and the securities world, because the brokers make a ton of money and so does the government. And insurance policies, again, are tax-free. And you would have paid taxes on your CD also. Okay, so zero across the board. Gross percentage of the gross is zero on the insurance policy, whereas it's 27%. So those drags on your policy, both in fees and taxes, are 27% with the brokerage and 29% with the CD. Okay, critical observations. The brokerage, that nightmare scenario. I'm liking Claude. They throw in these words that are so cool. The nightmare scenario, 2000 to 2002 crash. All right, here's where I want to bring up what I was going to say earlier. Between 2020 and 2022, you would have lost 27% of your investment. And that was due to 9/11. How many of you could have stopped 9/11 and the consequences thereof to the stock market? Nobody. Okay? And you lost it. And then what happened in 2008? We lost 34%. Whammo! It was like 3 months, if I recall correctly, which is a very short period of time in 2008. Here's my question. If you had chosen to retire in 1999, or you had chosen to retire in 2007, what could you have done to recuperate? Now, if you're a 40-year-old and you've got $1 million sitting out there, and that happens in 2000, in 2000 you're 40 years old, or in 2007 you're 40 years old, you still got 25 more years to recuperate that. And remember, it took from 2000, that's the next thing that it's saying there, financially it took till 2012 to recover from those two events. All right? So if you're 70 and you retire and you hit that in the year 2000, you're not going to get that money back until 2012. If you retired at age 70, now you're 82. What happened to what you had planned to do during retirement between 70 and 82? You see what I'm saying? That's the thing we can't time. We know the market's going to go up and down, and that's why it's risky. And that's why my friend that's, said, well, he got rid of his policy because it's not an investment. No, it isn't an investment. And part of your and by the way, this gentleman has a golden thumb for creating businesses as an entrepreneur. And yes, he's absolutely right. Putting his money to work in businesses has made him millions of dollars. And that's where the majority of his working capital should be right now, because he is young, right? But there should still something be put away for when you retire. And if that unfortunate day your car gets T-boned and you don't make it out of that T-bone, you need the insurance, because the amount of money you're making as an entrepreneur is not going to continue if you're not there. You are that special person that makes it happen. So again, this is not an investment. This is a storage unit. But because it comes with such a huge death benefit compared to the amount of money you've invested in your savings account, in the early years, if something happens, it's a huge windfall that will take up the slack for the lacking years that you were not around on this planet to continue investing in the primary thing you do, which is your business. Okay? So that's what I'm saying here. This is the best place to save money in a safe, secure environment. So let me recap quickly what we've talked about. You put your money in a bank, they own it. You put your money in a mutual company, you own it, okay? You own that asset. You have legal rights to get at that asset. The banks have incentives to do risky things and fail. And when they do, the FDIC only has about 1.27% of that money available. If they get the other 100 billion, which they would, because they have a line of credit, you're now talking, what, 2.3% or somewhere around there, if I remember correctly from what we just got through talking about. Even if it was 3%, it's nothing. And with only 3 banks failing, they still couldn't do it. So yes, you need to take a good chunk of your money when you're young and invest it in things that grow faster than a high cash value insurance policy. But at the same time, you should be squirreling away a percentage of that toward your retirement, so that when you are ready to retire, the ups and downs of the Dow, 2000 to 2003, the crash in 2008, we'll have another one. Right? It doesn't wipe you out. It doesn't decimate you, because who wants to put at risk their retirement and retiring just before 2000 or retiring just before 2008? So please get a hold of me. We can talk through this. Every one of these policies is created to fit your needs, not mine. I build these policies for you and your needs. So get a hold of me. I'd love to help you out. There's my phone number. There's my email. Get a hold of me. Let me help you. Thanks.